All right. Good morning, everybody. So it's FOMC day. Not really expecting a lot out of the market this morning. It's more about the afternoon. So we will get the publication at 2 o'clock, and then we'll get Powell at 2:30. And generally, there's like 3 moves that the market makes through the FOMC event. The first move comes at the 2 o'clock data. The second move comes when Powell does his pre-written speech. And then the third move comes after that. And when he starts taking questions, really, I guess you could say there's 4 moves, because after he takes questions, there's usually a move. But you know what? It seems more and more lately that the fourth move is more reaffirming the third move than anything else. But we'll see. Four pieces of data, 4 time frames in this event starting at 2 o'clock. So, don't get wrapped up in the first move. And in fact, I encourage you, if you day trade, to go back and look at old FOMC days and how rare it is for the market to pick a single direction at 2 o'clock and move in that direction for the whole event. It's a very rare thing. So just kind of keep that in mind, right? And there's no surprise when it comes to what we're going to do today. Nobody expects the Fed is going to cut today. And the Fed never wants to surprise the market. They go out of their way to telegraph early everything that they want to do. Japan is a great example of a market that responded well to being telegraphed first. Japan came out with whispers and rumor. Then they came out with, some hypotheticals of what it would look like. Then they started talking about the idea that they were thinking about it, right? And then they finally announced it. They walked the market up to their announcement, giving them time to contemplate it and prepare for it. That's what most Fed is going to do around the world. They don't want to surprise and shock the market. So we're well telegraphed that they are not going to cut today. The unknown is going forward. Are they going to give any sort of a wink or a nod on when they could begin cutting, what they need to see before they would consider cutting, and then the unity of the voting members on when that cut can come. So there's some unknown and there's some known. And Powell generally holds the line on being hawkish through his speech, right? When he's reading from prepared remarks, he does a reasonably decent job of maintaining that hawkish posture. Then he turns into a little dove when he starts answering questions off the cuff. So we'll see. I know a lot of traders who don't trade in FOMC week. They use this week for vacations and getting things done, and they just don't even bother. It's not a bad approach, I guess. To me, there's a lot to be learned about what's happening in the market and what our forward projections are going to be during this week, since it's not just US FOMC, right? It's usually a global time frame where we're getting rate decisions and information from around the world. So I don't generally tend to like the idea of ducking out, but nothing wrong with reducing position sizes and even cutting back on the number of trades. As to be expected, we're really not doing much this morning. The Russell's down the most, near 0.5%. The Dow flat with the S&P, and the NASDAQ up nearly 0.25%. Japan's doing the best, up almost 1% this morning. And Hong Kong is up a little bit. I was listening to some analysts that were talking about Hong Kong, how they're trying to, just kind of swap their numbers from housing to production right? They're doing a lot under the, or behind the curtain, I guess you could say it that way, on trying to boost things over there without just straight up using helicopter money. Really promoting manufacturing services, that sort of thing, getting away from the, kind of the gut punch of their real estate situation. We'll see. Thursday and Friday, we're going to see more Fed speakers, right? They've been in blackout mode. They're going to want to come out chipping teeth. And we've still got auctions this week. We've also got data coming out of Europe still. And you can see we're going to get a lot of data out of Japan tonight, too. So it's going to be a busy day. A lot of data coming in. Very likely we're not going to see a market that really gives us much direction, at least not in the index itself, right? It wouldn't really surprise to see equities doing pretty good. The call out yesterday was that we would get to the lower edge of the expected move and we'd do one or two things. A little bit of a Captain Obvious, right? When you get down to the lows, you're either going to turn around and go back the other direction or you're going to continue to go lower. And it didn't take very long for us to figure out we weren't going to continue to go lower yesterday. And so the call was that we would get to the other ADR. We were already on the low end, so we expected to go to the upper end. And we did. It just took all darn day to get there, but we did get there. A lot of stops and starts along the way, but it did finally get all the way up to the upper ADR. So yay for that. It was a right call, but there was a few times where it just seemed like we weren't going to get it. This morning, we're looking at a volume of around 50. This is really light. If we didn't know that today was FOMC, if we didn't know that there was an event on the horizon and we came in and seen volume this low, we'd want to call just time out right there and really go crawling through the news and trying to figure out what's going on that the volume is so light, right? Remember these morning briefings, I might give you a fish while we're doing this, but I do these morning briefings to teach you the steps to do your own morning briefing, right? So that you can tailor it to markets maybe you trade, right? Like the NASDAQ or equities, something like that. These steps will work. The same process works for whatever you want to trade. And one of the things that you really want to pay attention to in the morning is the participation from the overnight hours. What was going on around the world? A lot of times we get a carryover. If we have a really bullish day, then it usually carries over into the overnight. If the overnight has a bullish day, it can carry over into our market. Their negative news can carry into our market, right? So we want to know what happened in the overnight hours. And the simplest way to see what's going on is just look at the overnight volume. 50,000 is light volume. Now, we know it's FOMC. We know why it's light. It's not a big deal. But if we didn't know, if we seen that kind of number on a day where it was just a normal average day, you'd want to be concerned and go looking around and figure out what's going on. So they're sitting out. Volume's light. When volume is light, markets can really make a move. And I know that that's something that usually surprises newer traders, but low volume generates volatility. Volatility is a nerd word for movement. So low volume can equal big moves. Just think about the dome, right? The active trader on Thinkorswim or your depth of market. If it's a really thin market, then one big order can come in and move price a couple of points. Typically, the ES has hundreds of contracts per tick. So a big order comes in, maybe it moves 2 ticks. You look at something like the NASDAQ, which generally has 10 or 12 contracts per tick. One big order can come in and move the NASDAQ 3 points, right? So if the ES starts to get thin and looking like the NASDAQ with double digits instead of triple digits, it doesn't take much, one big order to come in and move the S&P a couple of points. They're hedging. They are a little concerned about what we're about to get. This is not a guess. I'm not assuming that they're hedging. We know for a fact that they're hedging. The thing about a hedge is it doesn't matter if you're bullish, because you can hedge bearish. If you're bearish, you can hedge bullish. Markets generally make big moves because people were caught off sides and then everybody's scrambling to change their position. But if you're hedged, you don't scramble. You're not off sides no matter which direction we go. And that reduces the move that we see and it reduces the volatility that we get. Now, don't get me wrong, you're still going to get those kind of big spiky bars, right? Like CPI and non-farm payrolls. FOMC is going to produce those kind of bars. But the move generally won't stick. That first initial pop that we see, since they are so heavily hedged, it won't stick, right? Not that first push. So with the market maker move, one of the things that we can do with it is we can add it to the ADR. We got the yellow line on the upper end, 52.91 COG line. We could add another $11 to that, or 11 points, or 1/4%. That would get us at what, 53.10, 12? Yeah. 53.003, something like that. To the downside with 51.87, you're looking at 51.76-ish. One thing we want to keep track of is this number. Is it going to continue to get bigger through the morning? And that's kind of the expectation, is we expect it to get bigger through the morning. This is really early to be hedging when the event is at 2 o'clock. So we got plenty of time. Through the day today, we expect to see this number to grow. And if you're on a platform that doesn't have market maker move, as long as you have options data, you can see the market maker move anyways. On Thinkorswim, if there's a market maker move, it shows up right here. If there's no market maker move, then there just won't be anything there. I continue to point this out because people tell me, hey, I'm on Thinkorswim. Where's the button to turn on to get the market maker move? You don't get to turn the button on. If there is one, it shows up. And if there isn't one, then it doesn't show up. That's a flaw that I don't like. I've wrote and told them that they need to just leave the words market maker move there. And if there's no market maker move, then leave it at 0, right? But at least leave the darn thing there so people know where it is. And they're not sitting there trying to figure out why it's not showing up and how to turn it on and off. I'm just one person, though, and they don't listen to me. So if you're on a platform that doesn't have that, what you want to look for is the average implied volatility. Most options platforms have this. So you look at the front expiration, which is the one closest to expiring, and then you look at the next expiration, the next expiration out, what they call the back expiration. If there's a market maker move, the number in front will be higher than the next number down. That shows that they're in there trading in the out of the money options, and those out of the money options trades are increasing the implied volatility average on the front end, and we get a market maker move out of that. So like I said, I'm not guessing or assuming that they're hedging. I know they are. The funny thing is, this market maker move is something that they've wrote about extensively at a website called The Ticker Tape. It's a publication made by TD Ameritrade, and it's been around for years. They never talk about it from a futures point of view. They mention it for earnings and biotechnology, like events, new drug trials, things like that. They never once, so far as I've been able to find, ever referenced it for futures or for hedging to recognize the way that we use it, really. And I don't know, maybe it's just short-sighted on their part, but you can certainly go there and search market maker move. You'll find a lot of articles about it, explaining what it is, why it was made, how they use it. They don't use it the way I do. It's their loss. But we know how this number is derived. And we know that that can easily signal that they are hedging. And that's a huge benefit for us, right? Now, we know why they're hedging because it's FOMC. But imagine those days that you come in here and the volume's really light and there's a market maker move and there's nothing on the agenda. There's no economic event scheduled. There's no reason for a market maker move to be there or for the volume to be so light. Then you've got a heads up that a lot of other people just don't have. They have no clue that the market's about to do something violent and volatile because they're not looking at market maker move and they're not noticing that everybody's sitting out. The put wall was rolled down yesterday. It's basically sitting at the 10-week. It's outside the previous week's low. To even think about getting there, we would have to cut through the 10-day, the 3-week. Yesterday's low. There's just so many pivot points to get in the way for us to get down to that put wall. Zero gamma volatility trigger, the daily pivot point, weekly pivot point. There's a lot to work out in that level. Remember, we almost hit the weekly expected move on Monday, and we are now above Monday's levels. So we're getting really close to the edge, or we're there yet. Let's just go over and see it. This is the 10-day, 30-minute volume profile. Mentioned yesterday that we could see a shift in the point of control. If we stayed at our current level, we didn't really see much of it on the volume profile, but on the TPO, we have an adjustment now, 52.36. The range is still pretty tight. Obviously, unless we break this range, we're not going to see a change to the profile. It is a classic D shape, and I don't see that changing in any way. We would have to come down to something like 51.75 or 51.80 if we were going to build out, like a classic B. And for a lowercase b or a lowercase p, then we'd either need a big expansion to the upside, call it like 5,300, or a big move to the downside, something like 5,100, for us to even consider a profile that looks like that. So at this point, we really got nothing. Even the point of control is not really helpful at this point. It is worth noting how narrow the 70% zone is, the one standard deviation. 70% of all the volume over the last 10 days is within this very narrow scope right there. That's a nice scoop pattern that we're getting right here. That pattern works on any time frame, but generally on a weekly is where I like to see this setup. Let's see if we get any sort of follow through out of it. We hit the VPOC yesterday, tried a first touch play to trade setup. I got ran over, but really the losses were contained to commissions, basically. I'm okay with that, but generally a first touch play will give you a little bit more than that. It didn't give much of anything. But we're done with that one. And we can now move it up because yesterday it gave us a VPOC that we haven't hit yet. That's a cog line, 52.32. So the expectation is if we go to the downside, we're likely to hit that. You could look for a first touch rejection on that. I mean, it's possible. You got kind of a classic B. If we break this structure of yesterday, we're likely to fall through the shallow area really quick. And we would end up around that 52.11 cog line, maybe a little lower than that. So the VPOC is almost a line in the sand. No, I don't have it on this time frame. So if we're looking for those voodoo lines, new voodoo lines came out, and I have not saved them into the chart, so they just didn't get plotted. On March 14th, they came out with new voodoo lines. So there's Forest right there up against it right now. You won't have to worry about those voodoo lines, especially on the futures, going away, right? They don't change very fast. On the equities, a lot of times it's, well, not a lot of times. It seems like once a month they're changing the voodoo lines on the equities, but on the futures, they just don't change very fast. So shouldn't have to be too concerned with those at the moment. I don't think they're going to change until we get, above the 54. Kind of zoom out here to see. Yeah, if we get up somewhere around that 54, 50 area, I think they might reconsider putting out another set of voodoos, but until then, I wouldn't be too concerned with it. But you are right, that Forest level is a big deal. It's one of their major voodoo lines, which is why it's so bright in relation to all these others. This white one, Snow, is another really big deal, but that's a long ways off. So we deal with what we got, right? They are continuing to grow that hedge, not a surprise, and I expect it to continue through the morning. All right, there's our weekly expected move too. 52.47 and a tick. I knew we were getting close. Yeah, I do use a strategy where if we get to the edge early enough in the week, I take the other direction. But by early in the week, I mean Monday or Tuesday. We didn't get there. We didn't cut through it, get above it on Tuesday. So I wouldn't try to go the other direction at this point on Wednesday. Not to say I think that we're going to break out and continue to go higher, but one, you're talking about trying to go into the market with a direction with FOMC this afternoon. And there's no edge in trying to predict what we're going to get from FOMC. None. It's a guess. There's no amount of technical analysis that you can do to the chart to figure out what the market's going to do today. So there's no reason to try to take the other side of this trade and go the other direction. Just let Powell come out and do whatever he's going to do, and then see what the market's going to do after that. There's a lot of examples of what we get for FOMC. And really all it takes is just to go into the past, bring up some charts, and look at what the market has done before. If you do that, if you go and look at those different FOMC dates, it helps to know what the decision was. Did they raise? Did they cut? Did they hold? Right? That data will help you better understand whatever it is that you get on the chart. So it's just something to consider, right? This is the SPX weekly expected move. 51.81.61. So we're still more than 3.5% away from the 10-week moving average. That continues to show how bullish we are, not quote overbought per se, but we are extended. There's been times where we've been higher than this. So, we're not at extremes. It just continues to show this market holding these levels. And while the indexes themselves really are in a holding pattern here, a lot of other things are making moves, right? So that's a bit high. We expect it to come back down. It needs a reset at some point, but we've been holding these levels since QRA back in November, right? The next QRA that we're going to get is May 1st, or first week of May, say it that way. So we're not going to get anything that can really throw this off the rails other than the data that we're going to get today. And for the daily, we're back above the 10, more than 0.5%. But if we look at what our average has been, we're about halfway. This is the zone that we've been holding in, with the high of around 1.5 and the low right about 0. So we're almost in the middle, not overbought by any stretch of the imagination. So the little bit of a move that we've had this week that got us to the edge so fast, it didn't put us in an overbought condition. It doesn't owe us any sort of mean reversion or, pullback, anything like that. We're just not overbought. All right, so we are getting into levels on US dollar Japan that would have been intervention levels, and have been intervention levels in the past, but there's not going to be any intervention this time. Also, they are using the 10-year Bank of Japan 10-year, which is why we're seeing this disconnect between the dollar and the 10-year yields in relation to what we're seeing with US dollar Japan. So if you go over to something like TradingView, you can bring up the 10-year for Japan. And then you can, of course, see US dollar Japan. We're getting into that level. This is like uncharted territory. We don't know the ramifications of everything that's going to come from this decision that they've made. And remember, the markets don't like unknown, so it's kind of a big deal. This is worth really keeping your eye on. Watch the news, anything that has to do with Japan and this decision that they made, any article that you come across is worth reading, understanding what a lot of the analysts are talking about out there. There's not a consensus on what we're going to get here. Oddly enough, gold generally gets a little bit of a bullish move for FOMC. That's the story anyways. I've heard this now for a couple of years and I've never done the work myself to go in and look. It's easy to just make those kind of comments off the cuff, but I don't have any data to support it. I don't have any seasonality info. I don't have any, correlation with FOMC events, but I've heard it now enough that it's starting to just become this thing that I believe, even though I haven't seen it. Gold generally gets bullish for FOMC. Now, if you have the time and you want to dig deeper and then share that data, I would really like to see it. I just never seem to have the time to go do that work myself. Gold's kind of a generic phrase. There's, GLD, gold miners. There's a lot of different ways to look at gold. So I don't know. You kind of do your own DD. If it is true, then, at every FOMC event, you have that opportunity to play some kind of gold trade, whether you're just going to run, a reversion trade back to the mean after FOMC ends, or if you're actually going to trade it for the move, the move up. Either way, I don't know. It's just something I wanted to share with you guys. I don't have any data to support it though, either way. Bitcoin's worth keeping your eye on. If we break this low, then we should get a move back down to this previous structure down here around 52. And even if you don't trade Bitcoin, there's a lot of Bitcoin proxies that you can trade. Riot, Mara, Hut, Hive, Coin, MSTR, all those different stocks and ETFs that you can trade with options, so there's a lot of tradable opportunity in that. If it holds and runs back up, every one of those same names become tradable opportunities for longs too. So with this really strong pullback that we got, it's kind of a nice setup. Just keep in mind this wick, right? It shows a lot of structure back here, a lot of defense around that 60K level. So you could use that 60K as a line in the sand. It's a simple, big, round number, easy to focus on. Below that is bearish, and above that is bullish. For bullish, though, you kind of need a trigger to go. And we've got a very close big bar. So there's a half level. Call it 65, really, or 64.7. That's a better way to. 64.7. That'd be getting through the half back of this last big bar. You can go that route. Or you can use this big bar back here. Or you can use the entire move if this does prove to be our low, you can measure it from that point, or you can measure it from that point. Either one. So it kind of, those yellow lines kind of highlight the risk here. Interesting enough, no matter which one of those yellow lines you use, if you just focus on something like a TRB setup, a trend line breakover, then you just want price to get above that trend line anyways. And you don't need to be very specific about where you draw the line, because price doesn't care where your line is, right? Nobody sees the line but you. Markets aren't responding to your line. Nobody cares, right, where you put your line. So it's not going to affect the market. It's just at what point do you decide that a trend line has been broken for the TRB, right? Otherwise, if we break that 60K, then you could use 59,313 as kind of the trigger to short. And from 59 to 52, or 53, somewhere around this low, plenty of movement either way. Thought it was worth mentioning because, looking at equities this morning isn't going to really do us much good. Whatever we get from FOMC is going to affect equities. So I don't know what's up with Wells Fargo this morning. They shouldn't be down that much. Oh. Citigroup and others downgraded Wells Fargo because it had a nice run. Okay. Whatever. That's a nice buy the dip opportunity. So that's what I got, guys. Keep your eye on the clock. Tiptoe around equities today. Wait for Powell and be careful.